Subsequent accounting is two ways. One way is amortized cost. If you have a liability at amortized cost, well, we've done this. You don't remeasure the liability. You still charge a finance cost at the effective rate. So the liability would go up with the finance cost and go down with any repayment, but you just would not remeasure the liability. So it is said to be at amortized cost. This is your default. This is the normal way of doing it. Yeah, we charge P&L with a finance cost at the effective rate. At the effective rate. There is no year-end remeasurement. There is no year-end remeasurement. If you own some plant, you have plant at depreciated cost. So you have plant, and although we use and say plant is a cost, actually the figure for plant will change over the years as it comes down due to depreciation. But there is another way of measuring plant. Revaluation, yeah. So you can measure assets in two different ways. Cost or fair value. You can measure liabilities in two different ways. Cost or fair value. So we have a mixed measurement system. And in principle, I haven't got a problem with that, because if we have a mixed measurement system for assets, why shouldn't we have a mixed measurement system for liabilities too? Why should fair values only relate to assets? We could bring fair values into liabilities. It makes it very messy, it makes it very complicated, and I think this evening I don't want to swim in that pool. That is something we will look at next time. What I want to nail tonight is liabilities at amortized cost. Next time. Next time. Please, can you turn to broad? Please, can you turn to broad? Page 142. Please, can you turn to broad? Page 142. Broad borrows money by issuing a $20,000 6% 4-year loan note on the first day of the accounting period. The loan notes are issued at a discount, will be redeemed at a premium, the effective rate is 12%, and the issue costs are 1,000. I need to slow down. I want this to be something that we savour and that we enjoy. What is the 6% coupon rate? The 6% is known as the coupon rate. If we issue a $20,000 6% loan, what does that mean? The nominal value of the loan is 20, the coupon rate is 6%. What do we get if we multiply the coupon rate by the nominal value? Well, on one level we get a figure called 1,200. Now, we've got to really flush this out. I want to be quite sharp in our language. Cash, thank you. It's cash. Don't use the word finance cost. In fact, I'd almost rather you didn't even use the word interest paid. This is the cash that we pay. This is the cash paid. Credit, cash, debit, liability. This is the cash paid. So I want us to be absolutely clear. The coupon rate times the nominal value gives us the amount of money that we pay, not the amount of money that we charge to the P&L. That's not the finance cost. That is the amount that we pay in terms of cash out. Now, if I have a liability, what I want to do with the liability is have initial recognition at fair value. The initial recognition is at the net proceeds of issue. So the initial recognition is at the fair value less the issue costs, or to put it another way, at the net proceeds of issue. How much cash do I get? I like 18,000. I do like 18,000. And the reason I like 18,000 is because it's a 20,000 bond issued at a discount. The discount is 10%. So you only physically receive 18. But let me ask you the question again. What is my net proceeds of issue? 17. Because it's net of what? Issue costs. So the fair value less issue costs, in other words, the net proceeds of issue will be the gross proceeds, which is 90% of 20,000. The gross proceeds of 18 less the issue costs. You've only received 17,000 in cash. You've only received 17,000 in cash. Debit, cash, credit, loan, 17. You physically only received 17,000 in cash. So your starting point for your liability is 17. Debit, cash, 17. Credit, loan, 17. Now what happens to that liability is that liability runs at amortized cost. What happens to that liability is that liability, that loan, runs at amortized cost. And when we think about amortized cost, I have an opening balance on my liability of 17. Now let's get the first year right. How much do we charge in the P&L? 12%. How much cash do we repay? And what is our closing balance? So 17,000 plus 2,040 minus 1,200, that is 17,840. Now let me just stop and admire the beauty of this calculation. That's my expense, that's my charge, that's my expense in P&L. What's that figure? Well, I know it's 17,840, yeah, but that's the liability. Yeah, that's the liability. Now, the liability's just got bigger. The liability's just got bigger, so all of that is a non-current liability. Now, that 1,200 is a cash flow. It's a payment. Yeah? So, I don't know if you remember cash flow. We will do cash flow. We will do cash flow. But when you do cash flow, you add back the finance cost. And then at the bottom of the operating section, you've got interest paid and tax paid. And then that'll be the interest paid. So you add that back in the cash flow. Now, because I want you to understand, because I want you to accept, I'm going to do years 2, 3, and 4. In the exam, I don't think you'll do years 2, 3, and 4. I think in the exam, the question will only really require you to do the first year because you cracked it by then. But I will, for sake of wanting to dissect and sort it out, yeah, do the second and third year. $17,840 multiplied by 12% gives me a finance cost of 2,141. We're paying 1,200. 17,840 plus 2,141 minus 1,200. We get 18,781. 18,781 at 12% gives me 2,254. So 18,781 plus 2,254 minus 1,200 gives me 19,835. 19,835, take that at 12%, is giving me 2,380, and I pause. I will make my regular payment of 1,200, but I'm pausing in year 4 because this is the final year. And in the final year, I redeem the bond. How much do I pay back? 1,015. I redeem it back at a premium. So I pay back the nominal value of 20, and then I also pay back the premium of 1,015. So for the avoidance of any doubt, 19,835 plus 2,380 gives me that, and that indeed then brings me to a nil situation. So in the life of the liability, yeah, this is representing your expense, this is representing what has been paid, and that is representing the liability. You know this to be true. It will humour me if we add these numbers up. 2040 plus 2141 plus 2254 plus 2380 is giving me here 9088. 2040 plus 2141 plus 2254 plus 2380 gives me another number. 8815. Third time, double check. 2040 plus 2141 plus 2254 plus 2380 gives me 8815. So yeah, quick audit of the numbers. Yeah, just pausing. Yeah, are we happy with this so far? Now, I would like you to understand what that comprises. So I would like you to understand the makeup what comprises our total finance cost. Look, concentrate on this. If you borrow money, it will cost you. If you borrow money, there will be an expense. Now, over the 4 years, the total cost is 8815. I would like to build that up in a totally different way. Why? What have we charged? Why is there a cost to borrowing money? What are the costs in this question? Well, you're then just repeating the 8815 because the 8815 is the effective rate of interest, 4 numbers added up. So it's going to get back to square one. What have you paid that makes the 8815? The issue costs. One of the expenses that you've paid in order to borrow money is the issue costs. So one of the part of the cost of borrowing the money is the issue cost. And the issue cost is 1,000. I haven't finished. I will only finish when I get to 8815. The interest. The interest that I have paid. The interest that I have paid is only part of the total finance cost. The interest that I've paid has been $1,200 a year, and I've paid that for 4 years. So I have paid $4,800, and as a result of paying that money out, it's cost. I've written that off to the P&L. What else do I write off? The discount. When I borrowed the money, I got 18. Well, I got 17, but I've dealt with the 1. I only got 18, but I paid back 20. I paid back more than I borrowed. That's a finance cost. If you pay back more than you borrowed, yeah, that makes sense to me. So the discount on the issue. The discount on the issue. And the discount on the issue was 2,000. Still doesn't add up. The premium on the redemption. The premium on the redemption. And the premium on the redemption is 1015. Looking good to me. Yep. 8815.